Hello, everybody. Thanks for tuning in to another episode of the Your Gray Matters podcast. My name is Jason, and I'm the producer of this here podcast. Longtime viewers and listeners to our show may be familiar with our guest this week. That is Bryce Bettencourt. And Bryce was our very first guest way back in May of last year. Bryce is here to comment on the recent prime interest rate change by the Bank of Canada, also to talk about mortgages, mortgage insurance. I will say that this podcast episode does get fairly technical, but Bryce delivers it in a way that's easy to understand and quite relatable. So if you have questions about mortgages, what the interest rate change may do to your mortgage, fixed term, variable term, mortgage insurance, anything like that, this is an episode you don't want to miss. Please remember to like, subscribe, leave a comment. It's really helpful in getting the word out about the show, and tell a friend. Enjoy the episode. Welcome to Your Gray Matters, the podcast that unveils the miracles already amongst us. Here, we believe that the human mind cannot be defeated. Tune in to discover the fascinating people with extraordinary stories, innovative products, and groundbreaking services. With your host, Neil Silvert, who's earned his gray hair and still has use of his gray matter.
Hi, everybody. I'm Neil from the Your Gray Matters podcast. Welcome back. We are so glad to have you on the show today. And we're really excited because in April of 2023, we kicked off the Your Gray Matters podcast. And our first guest is back in the hot seat today, Bryce Bettencourt from Chartered Finance, a great mortgage company. Hi, Bryce. Welcome back.
How's it going, Neil? Glad to be back. Sorry it's been taking so long, but I guess no better time than the present.
You got it. And I have to say, we have seen some serious changes in the mortgage world since April of 2023. And ladies and gentlemen, that's why we're having Bryce back, because we want to catch you up on the world of interest rates. You might not find them exciting or interesting, but they are in your life every single day. And Bryce, we have a strange phenomenon going on right now, or maybe it's not strange, but interest rates are coming down. And I was wondering if you just might comment on the changing mortgage rates and what you're seeing for people.
Yeah, definitely. Obviously, first and foremost, with all the excitement with the rates coming down, directly correlated to Bank of Canada and where the economy is right now and where everybody sees the economy going. So the one thing I'll chime in on that note is obviously the inflation numbers last month have come down significantly. They're at about 2.4 or 2.5%. But when the month prior, they're at about 2.9. And the month prior to that, I think it was at 2.7, but then the month previous was at 3. So long story short, with them trending down at, 2.4 to 2.5 right now, Bank of Canada's, taking their foot off the brakes completely and letting the rates fall. So the last 3 Bank of Canada meetings, they've dropped the rate by 0.25%. So now the lending overnight rate is at 4.25, and there's inclinations that they may be dropping the rates again the next 3 meetings. Okay, the next 2 meetings till the end of the year. And honestly, in my opinion, I see them dropping rates every meeting all the way up until next year, if I'm being completely honest. So a couple dates to highlight, in October and again in December, you're probably going to see rates being cut another 25%, 25 basis points at each of those meetings. And don't be shocked if at one of those meetings, they decide to do a 50 basis point drop.
Wow.
And I mean, to that note, those rates directly are correlated to the variable rate. And if I had to chime in a little bit on how it affects the fixed rates, because that's some of the questions I get asked a lot is, is the rates are dropping, so that means the fixed rates are going to drop too. Not necessarily. Fixed rates are based off of 5-year bonds. And yes, there is obviously a correlation between the bonds and inflation in general. And as the unemployment rises and as inflation starts to drop, the bonds will follow suit because the economy is not doing well right now. And in that, we're seeing a drop in the fixed rates as a result of it as well.
So just one question that I get asked a lot. Bryce, maybe you could touch what's the difference between the prime rate and the bank lending rate? Just a definition.
Yeah. So, I mean, to keep it simple, the Bank of Canada gives money to the banks at a cost of, let's say, 4.25. And the banks lend that money out based off of a discount on their prime. So their prime technically is a little bit higher always. So if we're looking at 4.25 for Bank of Canada overnight, prime currently is at 6.45. And for the variable rates, you can find them as low as prime minus 80 or prime minus 70. So you're looking at 5.75 to 5.65. So you can see the spread is about, 1.5% as of right now, as the overnight lending rate starts to drop. So the banks, that's where they make their money on the interest, essentially.
I see. And of course, the difference is when you get a fixed rate mortgage, the rate is fixed for a particular piece of time. Variable, it can go up and down. Maybe talk about variables a little bit.
Sure. So, I mean, where everybody was in a panic a few years ago when the rate started to increase, that's because their payments were readjusting when they have an adjustable rate mortgage. And just so that a lot of people are aware as well, a lot of the banks actually don't offer adjustable rate mortgages. They offer what's called like a true variable rate. And what that is when the rates increased, the payment stayed the same. However, the amount of that payment that was allocated to principal started to readjust to becoming more interest. So, for example, just to keep numbers round, if your payment was $1,000 back in, let's say, 2021, before rates started to increase, and in 2021, 500 of that went to principal and 500 of that went to interest. As the rates started to increase, there was a period of time probably where your whole $1,000 that you were paying was going straight to interest because the rates went up so much. So what had happened with that is that a lot of clients found themselves in a position where they had to either come up with the extra cash to pay down the amount that was owing that should have been going to principal to keep their amortizations in line, or they were asked to readjust their payments so that they can put their amortizations back in line. And some people are obviously just decided to keep their payment the same at 1,000, but their amortizations may have jumped from a 30-year amortization or 25-year amortization to 70 years because the amount of of that payment no longer going towards principal, they're effectively not, paying down their mortgage anymore. They're just paying interest. So for a lot of people that found themselves in a true variable, that was their situation. Whereas the people that have adjustable rate mortgages, their payments actually fluctuated and increased to the same kind of allocation to how much of it's supposed to go to principal and how much of it's still to go to interest. So the payment shock there is what hurt a lot of people because it turned into a situation where the payment was $1,000. It could have increased to 2,500 bucks. Yes, the same amount of money that was supposed to be the principal is, but the interest being increased, let's say $500 principal on the 2,500 and $2,000 to interest. It still kept them on track to pay off their mortgage in the allocated amortization period, but ultimately their payments going up by $2,500 is the reason why, you know, they felt the pinch. But now with the rates starting to drop, we're still not going to be anywhere close to what it was back in, 21, 22, but any little bit helps any client right now that's in a situation where, the rates are starting to drop for them.
Yeah, fully understood. And thank you for that, Bryce. And I think your last comment is the biggest. I know a lot of people myself who are going to have to renew at the end of this year or right early next year. And even though the rates are dropping, they're going to be paying more than they were paying. And people are going to have to start looking at their finances and being able to manage that change. And that's why a lot of people are coming to us, of course. Ladies and gentlemen, for those of you who don't know, in addition to being a podcaster here, I'm actually a licensed mortgage agent, and Bryce is the broker that I work with. Bryce, when the banks say no, where do people go? It's a big question. I found a lot of people don't realize that there's a whole world outside of your favorite bank that can help you. Maybe talk about private lending and the different kinds of private lending and how that works.
The mortgage world has changed a lot in the last couple of years with the interest rates and all that kind of stuff. When money was cheaper, private lending was a lot more lucrative because a lot of people would utilize some of their own lending capabilities, whether that's using a line of credit that maybe they were borrowing at 4% and then lending out at 12%. So they're making an 8% spread. So there's a lot more private lenders in the industry. But since the rates have increased, private lending has become a little bit more expensive, but also a lot more conservative. And what I mean by that is when the rates were super low, obviously housing prices were through the roof. And nowadays, a lot of these private lenders that are still lending money, with the markets decreasing and the values of properties decreasing, they've opted to, maybe lend at a lower loan to value than they did in the past, right? So, let's say a property value coming in at $1 million, lenders in 2021 would say, yeah, if it's $1 million today, that's probably 1.2 million next year. So lending you 800,000, so 80% loan to value, seems like a no brainer if you're protected by that equity over the next year and by inflation. But what happened was when the rates, obviously when the market came down and crashed a little bit, there's a lot of people that lent that 800,000 and the markets took a 20% hit. So the value of that home, instead of going to 1.2, was at 800,000. So there's a lot of lenders out there right now that, have lost some money, in the last couple of years because of those things. It's forcing them not necessarily to lose, but maybe to also prolong their investment to allow for the market to recover, for the house to be worth a little bit more. But the main thing we've seen in the private lending world now is a lot of lenders are just being more conservative. So if a property value is coming in at $1 million, because it's a bigger loan size, maybe at 800, they're scaling back to maybe 750 to 700,000 as being the limit, because they want to avoid any kind of potential conflict that could happen if the market doesn't adjust or doesn't go up. It's still giving them enough room to exit the loan if the client can't properly, right? So, one of the main things that we're doing for our clients prior to getting into any kind of processing of any kind of private mortgage, we are going through that appraisal process up front. That way it doesn't put us in a position of having to overpromise and underdeliver. We are being given the exact evaluation. We're taking these evaluations to lenders that fit that bill properly prior to, as opposed to doing all the legwork, finding a deal in regards to pricing for these clients without really knowing truly how much the property is worth, and even if it qualifies for those loans, right?
And Bryce, thank you for that, because I get a lot of questions about what happens when the bank says no. Bryce, one of the biggest questions in that area, but actually it affects the bank world now when you go to the bank, is the appraisal. A simple question. Ladies and gentlemen, if you're going to want to borrow money, you're going through an appraisal of your property. Bryce, I get asked all the time, Neil, what should I do to prepare for this appraisal?
So in preparations for appraisals, honestly, a lot of people get overwhelmed with that as well. They feel like, but I had to clean the house or the appraiser comes in. Honestly, the appraiser is looking at the property very subjectively and as in comparison to other properties that have sold. So yeah, if you forgot to sweep a dust bunny up, that has you know, there's no relation to how much the value of the house is worth.
Right.
However, if you have paint peeling in the living room, yes, that will have an effect on the valuation of the property, because if the property was sold and there was another property that was recently sold that was very similar, but it was fully painted and it sold for 700,000, just using a random number, and your property is not properly painted, they would take into account, okay, how much is paint, let's say it's 5K to repaint this house. You're going to lose potential value because the house that's properly painted sold for 7, and your house not being properly painted would cost money. So effectively it's not worth the same as that house. So, things you could do to prepare, honestly, it's more structural things. If there were anything, if you're missing switches or if the door is broken or if there's water damage. These are things that appraisers look for. But if your house structurally is fine, it has a little bit of clutter, that has no hindrance on your value at all. So never feel that you have to delay because you have to sweep the floor. You know what I mean? That's not going to change your value by 10 grand if you swept it or
Okay, fair enough, and thank you. And of course, if there are questions, we can always guide people, but it is a reoccurring question right now for sure. Bryce, when a person takes out a mortgage, they should be taking mortgage insurance of some type. How about touching on mortgage insurance?
I've definitely been a bigger advocate of taking mortgage insurance simply because they've recently changed a lot of their options. Where in the past, it used to be a 100% coverage no matter what. Whereas now they're giving clients the opportunity to do 50% coverage or even 75% coverage.
Hmm.
And, and at the end of the day, through the brokerage, at least, we've actually eliminated a process with the mortgage insurance where we used to operate by a one pager, like a form to sign off on. Now there's actually a link that takes you to a website where by typing in your birthday and identifying whether you're a smoker or not, you can actually get a breakdown of all your coverages and your quotes just simply on the computer. So from a visual perspective, it's a lot easier to see if the product is good for you. And if it's still not good for you, it gives you the option to wait on that website instead. So by taking out a process for us, just telling somebody, what is this piece of paper that I'm signing off on, and saying, hey, go to this link and do your own homework. A lot of people are actually recognizing that, for some of the cost of these premiums, it's a drop in the bucket when it comes to, purchasing a house, and it protects them in the event that something ever happens to them, whether it's, heaven forbid, if they pass away or if they get hurt at work, their mortgages are covered. Right. And the other side of that coin, some people would say, well, I already have life insurance. That's fair. Let's say you have a 500K policy. Your mortgage is 400K. If something happens to you, that 500K comes in, 400 of it gets gone, and your family's left with 100. But what if you took mortgage insurance on top of your life insurance and you only covered 50%? And that 50% costs you $20 a month, $30 a month. Now, 250 of your 500 gets covered because you have a 50% policy. And the other 250 comes out of that 500 life insurance policy that you have. And now your family's left with 250 instead of 100. Those insurance policies follow you around as long as you own a home. So it's one of those things where you're unsure, you may not live there for long, but you're going to own a home. And if it's affordable, obviously affordability is huge with this kind of stuff. Definitely explore your options, because in today's, like how we mentioned with all the rate talk, if we can save you $100 a rate drop because you're at a variable rate and mortgage insurance costs you $50, we know that with a rate drop coming in October, now you can afford that policy.
Bryce, I want to thank you for that. I've just got one more question for you. And why should people use chartered finance as opposed to other companies or even going just to a bank? What do we offer?
We're professionals. We do this daily. We deal with all of the banks, all of the monoline lenders, trust companies, credit unions. So, you know, doing your due diligence and making sure that you're going to somebody who knows what's happening out there. Because the reality is, and you made a comment earlier about renewals, with rates dropping, banks are sending renewals in September for a renewal that's happening in December. But if the rates drop in October, the bank's not calling you back. They're not calling you back to say, hey, the rates dropped. You're eligible for lower rates. You know what I mean? They leave that onus on the client. So just simply having a relationship and reaching out to Chartered Finance, a broker, any of us, it's doing yourself a service where we look out for your best interest. So when there is a rate drop, we're the first people to say, hey, hold on. Don't do anything yet. There's a rate drop coming out next week. We're going to re-explore getting you a better rate next week. You know what I mean? And the advice that we provide these clients, it's invaluable because they would never know the difference under any other circumstance. Just trust that their bank is looking out for their best interest. But unfortunately, the banks aren't. So it's very important to us to make sure that the clients are looked after. And, I can't say that for every banker and I can't say that for every agent, but if there's one thing I know for certain at charter clients, that we look out for everybody's best interest in regards to our client base. So yeah, reaching out to us just for that alone, knowing that we have your best interest in mind, priceless.
And I have to say, as we close, Bryce, and thank you for that, you are an award-winning broker. Chartered Finance is award-winning for the terrific work that we've done for people. I'm glad to be a part of it. Ladies and gentlemen, I'm sure that you're going to have a lot of questions about mortgages. We will post my contact info for you in the mortgage biz, or you can just write to our podcast. If you have questions or concerns about your situation, don't lose sleep. Reach out to us. We will get you the answers. Thanks again for tuning in to the Your Gray Matters podcast. Bryce, thanks for coming on. We appreciate you. And we will see everybody next week on Monday. Thanks a lot. Thanks for watching. If you found it interesting and you liked it, give us a thumbs up. If you're ready to subscribe, click right here. And if you'd like to see another episode, click right here. Tell a friend. Send us comments. Thanks a lot.